Welcome to All Things Financial with Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're here doing a series on regarding financial planning for business owners considering or beginning to think about business transition. So we have a guest on with us. We're very happy and privileged to have Dan Zugell.
Thank you for having me, Jack. Appreciate it.
Thanks, Dan, for coming on the show. Dan's a Senior Vice President of Business Transition Advisor. So Dan, if you wouldn't mind telling us a little bit about what that is and what that process is for starters.
Well, sure. Thank you, Jack. My firm, Business Transition Advisors, is a national business transition consulting firm specializing in helping business owners transition their business either to key managers, to an outside buyer, but we also specialize in ESOPs, employee stock ownership plans, which are sometimes not talked about as enough as maybe they should be, Jack. And so that's kind of what we're going to talk about mostly today.
What I'd like to do for those of you who might have missed last week's show, Deanna, if you could go into a little bit again about what an ESOP is, where are the benefits, and catch people up.
Sure. Okay, certainly. Well, an ESOP is an employee stock ownership plan. It's not stock options. It's an employee stock ownership plan. And the term employee stock ownership plan, or ESOP for short, actually has some special meaning. An ESOP is a defined contribution, government-sanctioned qualified retirement plan. Very similar to a 401k, a profit-sharing plan, a pension plan, those type of retirement plans that are sanctioned by the federal government to give employee benefits and give the sponsoring company and potentially the selling shareholder of stock some tremendous tax advantages. And so they were put into the current law as we know it today with the passage of ERISA, Employee Retirement Income Security Act of 1974, and it's remained basically unchanged since then. And it's the law that put forth 401ks and gave us our rules of the vesting schedules and discrimination testing and total contribution rules and things of that sort. And ESOP falls right in line with those type of plans. And ESOP actually gives some special tax advantages that other type of qualified plans do not. And we're going to address that a little further today. And as we talk, and I know our last segment, we talked about some of the tax advantages that are in an ESOP, and I think your comment where that sounds too good to be true. And one thing to point out, we're going to dig deeper in those today, hopefully, if time allows. But just want to set forth the kind of the government view of how ESOPs work and the reason for them. The government set forth the ESOP law in 1974 with a couple revisions, updates, and actually very positive changes to the ESOP law in order to get employees of companies some independent wealth. The workers of a company who help build the value of the company will share in the value through shares of their company inside their ESOP. We didn't say it last time, but a 401k, as we all probably know, the employee defers money, the employer may match some percentage, and then the money that's contributed is invested into perhaps mutual funds a lot of the time. Well, an ESOP takes any money it has through contributions and invests in one thing. And that one thing is the company's stock, is the sponsoring company's stock. So it's one investment. And it's designed to get employees some independent wealth and therefore, in theory, relying less on the government safety net. And so you can see where both parties would really like it. The one side of the political spectrum likes the redistribution of wealth aspect of it. The workers, the true owners, the way some people look at it, are actually getting what's owed them. The other end of the political spectrum really likes the idea of tax advantages. And we're going to go through the tax advantages, again, at some length, but a lot of them, everything about an ESOP is either tax advantaged or tax free. And what grows American businesses more than a business that's tax advantaged or tax free? Hiring and profitability and expansion of American business is the point. So you can see where both parties, believe it or not, are in agreement on the ESOP concept. And that is shown by the legislation that was pending the last Congress that's going to be reintroduced this Congress, had about 100 co-sponsors with the political affiliation split right down the middle.
Really?
Yes.
That's a good sign for the future.
It sure is. It was called the Employee Ownership Expansion Act, and it's going to be reintroduced, and it's going to actually increase some of the tax advantages that we've already talked about that we're going to drill in even deeper later, and some other benefits to clean up some things that maybe should be cleaned up over the years that they never got around to doing. So very positive, as well as the state of Pennsylvania. Is looking to change Pennsylvania law. We are one of 3 states right now that don't recognize one of the tax savings. So our Pennsylvania legislature has a bill in front of it, the Shopping Co. sponsors, to change that to make Pennsylvania equal to the other 48 states, and I think we have a good chance of getting that passed. So
that's good.
We're working hard at that, Jack. So
how do these work, Dan? Can you explain just the general framework, how the ESOP work?
Oh, certainly. And there are a lot of moving parts. That's one of the comments about ESOPs. Boy, they're really complicated. And yes, they are. There's a lot of moving parts. But, a lot of sophisticated planning, such as estate planning and tax planning, is sophisticated as well. An ESOP is just a planning method and a planning tool that could be used for business succession in which the employees benefit, but there are a lot of moving parts. So we'll talk about kind of how these work right now. Well, the first thing the company does, it creates an ESOP plan and trust. It creates an additional qualified retirement plan. You might already have the 401k. You probably want to keep the 401k. We add an additional retirement plan. But this retirement plan, as we mentioned, has one investment. Its one investment is the stock of the sponsoring corporation. So in order to buy stock from the shareholder, it needs money. So in our example, we're going to assume the ESOP borrows money, ultimately from a bank. Now, the bank may not lend all of the sale price. In fact, they probably won't. So there are techniques of financing we will discuss a little later, but for purposes of the flow, after the ESOP is created by the company, the ESOP then borrows money, ultimately from a bank, and now it has money. The ESOP then uses that money to buy stock from the selling shareholder. But now the ESOP has stock it just purchased from the selling shareholder. The shareholder has cash, but the ESOP has a debt, right? It borrowed money to buy the stock from the selling shareholder. It borrowed money from a bank. So now the company makes contributions to its ESOP, its new qualified plan. It makes contributions every single year. And that ESOP uses those contributions not to reinvest because it has a debt, it owes money. So the ESOP then uses that contribution to pay off the debt to the bank that was incurred to buy the stock in the first place. And so that continues until the loan is repaid. And while that's happening, shares of the company that the ESOP purchased, and remember, this is an employee benefit plan. The employees are benefiting from the stock that the ESOP purchased. So over a period of somewhere between 20 and 40 years, the ESOP will release the shares that it purchased. It'll release the shares to employee accounts. So year by year, for 20, 30, 40 years, shares will be released into employee accounts. And the reason it's done this way is to prevent the have and have-nots. If the ESOP allocated all of the shares it purchased the day it bought the shares, anybody who worked at the company that day would have a bonanza. They would have a lot of shares in their account. But what about employees that are hired tomorrow or next year or 10 years from now? So by spreading out the allocation of shares to employee accounts with no out-of-pocket cost to the employees, by spreading that out over 10, 20, 30, 40 years, that creates a long-lasting, valuable employee benefit plan to the employees. The longer they work, the more shares they have allocated to their account, the more vested they are, because remember, this is a qualified retirement plan, and shares grow tax-free, and when the employees leave, they get to participate in the value of the stock. So we want to keep employees there. We want to keep employees working hard. We want to reward them through increased stock value when they work hard, and incentivize employees to find ways to make the business more profitable because they have an interest in growing the value of that stock. And so when you allocate shares over 20, 30, 40 years, you have employees that might jump on the train. They get hired next year, they jump on the train, and they can participate for as long as they work there, up till the 30 or 40 years are up. Somebody quits, they jump off the train. They no longer get shares of stock.
Well, now, can you explain how and when an employee cashes out?
That's kind of important to employees. Yes, Jack, that's a good question. Well, first of all, shares are allocated to the accounts of employees in a way that is generally, not always, but shares are allocated year by year over that 20, 30, 40-year period in a way that's proportionate to that particular employee's compensation relative to the total payroll. So if Susie has 2% of payroll, well, Susie will get 2% of the 1/30th of the stock that's going to be allocated that year. Okay. Next year, another 1/30th of the stock is going to be allocated over 30-year period if that's our chosen period. And if Susie had a raise and now makes 3% of payroll, then Susie would get 3% of that 1/30th that's being allocated next year. And that just continues every single year as employees jump on the train and as employees jump off the train. But to answer your question, employees do have share balances, and their share balances are payable upon 5 triggers. And the company has a legal fiduciary obligation to buy back these shares from the employees when they terminate. So the company must make a market for the stock. The company cannot say, hey, good luck to you, employee. I hope someday somebody will buy your Joe Cement Company stock from you. The government says, no, we gave you a lot of tax advantages. So the one thing you must do is maybe potentially use some of those tax savings to save up some resources and some reserves to fulfill your legal obligation to buy back the shares from exiting employees. And so when employees die, become disabled, they retire, they terminate, whether they quit or they got fired, and something called diversification, which is when they've been in the plan for 10 years and hit a certain age, they have a right to diversify their Joe Cement Company stock balance into more diversified investment portfolio like in the 401k. So when those triggers happen, the employees have a right to step up to the window and say, I have a stock balance and I want paid. And yes, they should get paid. Now, I often get asked, well, am I treating everybody equally? If somebody quits on me, am I treating the same as somebody became disabled or retired? And the answer is it depends on how the company chooses to set up their payment provisions. And many times you do not treat everybody equally. We do not want employees quitting to either buy a pickup truck or to start a competing business down the street. So if somebody quits or gets fired, generally you can make them wait. Perhaps an example is maybe make them wait 5 years and then pay them in 5 equal installments after that. Okay. That discourages employees from quitting immediately to get immediate cash to do things that may be against the best interest of the employer. Conversely, if somebody dies, becomes disabled, or retires, then generally treat them more favorably. And generally, you pay them within a year of that terminating event. And then they're happy. If somebody becomes disabled, they can probably really use the cash. Somebody dies, the widow or widower can probably use the cash. And they retire, they left on good terms. You might just pay them in 5 equal installments to help them with their tax liability in any given year and provide them an income stream. And then when the employees do get their cash eventually, when they get their money for their shares of stock and the company buys the shares back and probably recontributes them to the retirement plan, then the employees have the opportunity to roll over this money into individual retirement accounts. Because remember, an ESOP is a qualified retirement plan, just like a 401k. And so the shares that the employees get cashed out of can then be rolled into individual IRAs. And they generally do that with the help of their financial advisor.
Okay. Let me ask you, can the company have a 401k while they're operating and it's been transferred by way of an ESOP?
Well, the ESOP and 401k are separate and distinct plans generally. So generally both remain in force and active.
Okay.
Yes. The ESOP contributions may be larger than the normal 401k match.
Okay.
So many times an employer will say, look, I'm contributing a lot of money to this ESOP to pay off the debt, so I'm going to suspend the 401k match for a while. That happens often. But generally, you'd want to keep both plans around, and there's some practical reasons we don't have time to get into today that you really do want to keep that 401k in place as well.
And then you mentioned some tax benefits on this. Can you go through that again for us?
Oh, certainly. The tax benefits are really one of the drivers of why ESOPs are put in place. And in our last episode, you pointed out and asked me to talk about the non-tax advantages, which are important as well. But from a tax standpoint, there are four major tax advantages that are involved with an ESOP. The first is the oldest tax benefit that was been in the code since 1974 and one of the drivers of ESOPs, and it is for C corporations that put in ESOPs, Jack. Now, an S corporation or an LLC currently would have to convert to a C corporation to get this benefit, and part of the planning process is to weigh the pros and cons of doing so. However, if a C corporation installs an ESOP and the seller, the owner of the stock, sells their stock to the C corporation ESOP via Internal Revenue Code section 1042 or 1042, the seller can defer and indefinitely defer and potentially eliminate the capital gains taxes that are normally due on the sale of a business federally. And currently, the federal capital gains tax rate long-term is 20%. And under the current Affordable Care Act or Obamacare, generally an additional 3.8% is added on top of that for an effective federal rate of 23.8% that can be deferred and potentially eliminated altogether. Now, unfortunately, in the state of Pennsylvania, the little over 3% capital gains tax is still owed. However, as I mentioned earlier, there is pending legislation in the Pennsylvania State House to allow Pennsylvania to join the other 46 states that also mirror the federal legislation that says you do not have to pay the capital gains tax. So we are working on that wholeheartedly as we speak. Now, to get that capital gains tax deferral, there are several caveats, certain rules that have to be done. And one of them is it has to be a substantial benefit for the employees. So therefore, the ESOP must own at least 30% of the total outstanding stock in order for the sellers to be able to not pay the capital gains tax.
Okay.
And the seller, and this is important, the seller must reinvest the sale proceeds. So Joe of Joe's Cement Company sells stock and gets $10 million. In order to defer and eliminate the capital gains tax, Joe must reinvest that $10 million into U.S. domestic stocks and bonds. So it can't be mutual funds, cannot be a house. It has to be stocks and bonds of U.S. domestic companies that are actively engaged in an operating business.
Okay.
So it takes some finesse of financial advisor that knows, can meet these caveats, but when done, some tremendous capital gains tax savings that can be had. And frankly, there are some financial products that have been designed specifically to help selling shareholders facilitate this investment portfolio, in which the bottom line is that the seller can sell their stock, reinvest it into floating rate notes by major corporations, enjoy up to 90% of the assets and invest them wherever they want. Even though I just said they need to invest it in certain things, there are techniques and bonds that you can buy. You borrow against these bonds and then reinvest the proceeds in anything the seller wants. They're called ESOP floaters or ESOP notes. And so we could talk about that maybe on another episode, Jack, because a lot of folks like to hear about that. That's the first big tax advantage. The second tax advantage is for every dollar that's sold to the ESOP. In my example, a $10 million Joe Cement Company is sold to the ESOP. The company, Joe Cement Company itself, gets to deduct $10 million from its taxable income to reduce the tax burden of Joe Cement Company in any given year. So $10 million ultimately in total gets deducted. So that saves potentially $3.5–4 million of income tax just from the deduction alone.
Wow.
That's pretty nice. That's just the second tax advantage. Hold on to your hats, because the third tax advantage is, frankly, the driver. Now, this of today's ESOPs, the third tax advantage is for S corporation ESOPs. So whether you're started as an S and you just remain an S, or you were a C corporation and you want to convert to an S, when you do that, to the extent your ESOP owned, and most companies go 100%, you are now exempt from all federal and state income taxes on the profits.
Wow.
The profits of the company become tax-free. We've increased the cash flow of the company by 35 to 40%, depending on the state, and we use all that tax savings to pay off the debt we incurred to buy the stock from the selling shareholder in the first place. That is not a mistake. The government likes this. They want this to happen. And we're not kicking the tax down the road of the income tax. The tax literally goes away. The selling shareholder doesn't pay tax anymore. The ESOP's an exempt trust. It doesn't pay tax. That's why the company becomes tax exempt, because the owner of the stock of an S Corp, and the S Corp's a pass-through entity. Taxes flow through, the tax burden, I should say, flows through to the owner of an S corporation. If the S corporation is owned by an ESOP, and an ESOP's a qualified plan like a 401k, no taxes are due anymore. And so all that money stays at the corporate level to use to pay out any corporate purpose, including paying off the debt.
Dan, this all sounds too hard to believe. Can we go into the next show? We're out of time today. And you explain this a little more about what seems too good to be true, must be too good to be true. And this sounds so good that maybe we come back in next week's segment and you explain a little bit further about these benefits are real. They really work. You're seeing it happen. And it can happen for some of you listening and watching too.
I'd be happy to. I look forward to it.
Well, thanks again, Dan. We appreciate your tuning in to another edition of All Things Financial. Dan, appreciate your coming in as a guest on the show. We'll be back again next week.
Thank you.
Dan, if anybody wants to get a hold of you, what's the best way for them to do that?
Well, the best way to get a hold of me is by phone at 724-766-3998. That's 724-766-3998. Or Zugell, DZUGELL at bta.us.com, or visit my website at esopguy.com.
Very good. Thanks, Dan.
Thank you.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.